All right, welcome everybody, and thanks for joining us today. My name is Clay Malcolm here at Advanta IRA, and I'm happy to be joined by Badri Malynur of Avester.com. He's the co-founder and vice president. Badri, thanks a lot for coming today and offering some of your expertise.
Hey, thanks for the opportunity, Clay. Pleasure to be here.
Great. And I know that you and I were talking just a minute ago about the ability for you to have a sense of, who the audience is and that kind of thing. So did you want to talk about them adding some stuff in the chat?
Yeah, I mean, if people could just before we get started, just type in a line or two about your experience with investing in real estate, what type of real estate investments you have done, just a line or two, that would be great.
Yeah. And so we'll use the chat for that kind of information. And then from a housekeeping standpoint, I'd like to invite anybody who has any questions to go ahead and type those into the questions part of the console. And then we'll answer those questions as we get to the end. So from a structural standpoint, I'm going to give a little bit about information about self-directed IRAs, how they can invest in real estate, assemble a real estate portfolio within their IRA. And then Badri's really going to take the bulk of the time to talk about real estate investment and its kind of myriad possibilities and assembling a portfolio, and specifically a little bit about what Avester does, because it's kind of an interesting combination of technology and investment in terms of it being a platform. So that's how we're going to proceed today, and happy for everybody to have joined us, and away we go. I'm going to go ahead and get started on our presentation. So this is me. Obviously with the video you don't really need the picture of me, but part of the reason that I put it up here is because I've been in the self-directed IRA business for 10 years, both as a professional and as a self-directed IRA investor myself. And so one of the reasons why I thought that this presentation was going to be really fun was because I was going to get to learn some new things about, the way that technology is transforming my ability as a self-directed IRA investor to diversify my portfolio in ways that probably would have been pretty difficult to do without the technology part and without somebody kind of conceptualizing it. So so that's really my idea of being able to share some information both about self-directed IRAs as well as the ways that we can deploy our self-directed IRA money to hopefully create some returns for our retirement. And all the information in the presentation today is for education purposes only. We do not give any tax, legal, or investment advice here at Advanta IRA. We don't advocate any particular investment strategy or investment vendor. And we certainly encourage you to use your financial team and your real estate team anytime you are considering an investment, and use them to do the due diligence, because in a self-directed IRA, the due diligence process is really up to the account holder, and it's up to the level that you feel comfortable. So that means that it is your decision, but it doesn't mean you have to do it by yourself. So do please feel free to use your professional service providers to help you to analyze the best course of action for your IRA. And a little bit about Advanta. So we've been in business since 2003. We're kind of a medium-sized company for the space. So we were about $1.8 billion in assets under management. And we are a company that was built on customer service. So every account holder gets a two-person team here at Advanta, an education person like myself, and then also an account manager who's kind of the back office nuts and bolts resource. So you always have two people at your service where you have their phone numbers, their emails. You're able to get a hold of us and find out anything that you need to about a particular proposed investment or what's going on with your account, things like that. So we are built to serve the IRA, self-directed IRA investor, because again, we know what it's like to be one of them. I've really enjoyed being a part of Advanta because they do invest in my own continuing education, and a lot of the employees are long tenured as well. So it is a place for and about self-directed IRA investors. And when we're talking about self-directed IRAs, so a lot of you are probably pretty familiar with what the process is, but really at its core, I would say that we are talking about combining the tax advantages of these account types, and it is the account types that you already know, a traditional or Roth. Some people are not so familiar with health savings accounts, but those are also individual custodial accounts that can be invested in real estate. We handle solo 401ks and SEP IRAs as well as simple IRAs. So all these account types can be self-directed. Self-directed is not an account type in and of itself. It's just a descriptive term. So the account type stays the same. The contribution rules, the distribution rules, and the tax benefits are exactly the way that you know them to be in reference to any of one of these account types, whether it's traditional or Roth or one of the others. The only thing that's really different at a self-directed IRA provider like Advanta is that it can invest in alternative assets. So the investments that you can make do not have to be publicly traded securities. So it gives you an opportunity to diversify in a way that you wouldn't be able to otherwise, and to get into some investments that a bank or brokerage house IRA might not have. So we're talking about the combination of the tax benefits with the returns that you can make in alternative investments. And the investment choices that you have are a lot. It's myriad. You know, in broad categories, there's certainly residential and commercial real estate. And today we're going to focus a little bit more on commercial, which is sometimes a little bit of a jump for those of us who are, real estate investors. So we're going to learn a little bit more about that. But other types of investments are available as well: cryptocurrency, private equity, precious metals. Certainly, other types of variations on real estate like oil and gas, and sometimes the financial instruments that are associated with real estate like loans and things like that. Those are all available for your IRA to invest in. And so those returns get to come back in with the tax advantages of the account type. So that therein lies the ability to create the combination between the tax tool that is the account type and the investment. And when we're talking about real estate investments and assembling portfolios, and particularly what we're going to be talking about, what Badri's going to be talking about today, there are some things and some considerations that, obviously you will be making when you're thinking about adding this to your IRA portfolio. But, real estate investments in this form are not necessarily incredibly intuitive for everybody. So some of the things to think about, and this is not all of them, of course, are, which market do you want to be in? So is it going to be your local home market, or is it going to be somewhere else that you've read is a really lucrative market? Where do you want to be? What kind of commercial real estate are you talking about? If we're talking about commercial, so is it multifamily residential? Is it an office building? Is it a storage building? Is it a shopping center? So all of those types of things may be part of your preference for the way that you would like your IRA money to be deployed. The investment structure can be different. So that might be a direct ownership of your IRA owning something, or you might be a limited partner or a member of an LLC that is gathering investors for a larger purchase. It could be a REIT. Also, again, as I mentioned before, sometimes the financial instruments that are associated with real estate are also investment tools. So it could be debt or something like that. Level of transparency and information, I think, is always an important thing when you're thinking about your due diligence. Just how are you going to get information about the investment? Is it ready all the time? Is it available sometimes? Do you get a report once a year? Is it once a month? Is it once a week? Every day? So, your comfort level with getting information about the investment, I think, is always an important thing to investigate. And I do encourage you to ask as many questions in your due diligence process as you need to feel comfortable. Again, using alongside your real estate or your financial team to make sure that you're comfortable with what you're doing. And then the last one there that I have on there is just one of these things where I always encourage people when they're talking about their IRA investments to think about the end game. So what is your distribution strategy going to be? What does the rest of your financial world look like? An IRA is really usually only a portion of what your overall financial picture is going to be. So how does it work in concert with the rest of your financial world? And when it comes to the investments that your IRA is going to make, what's the timing of the returns? How liquid is it? How much flexibility do you have? All these things are good considerations when you're thinking about, hey, how am I going to build my portfolio? How am I going to decide which investments I want my IRA money to be in? Because we're all different ages, we have different financial needs, and investments pay off differently. So finding out how and when they do that is a key component to the overall kind of idea. And, for those of you who think that, IRA investing is, if you haven't done it yet, self-directed IRA investing is very complicated or takes a long period of time, I would say, it really is not. So it's the normal process for somebody is to open an account with us. It takes a business day. They will move some money into that account. That's step 2. So usually it's a transfer from another IRA or a rollover from an old 401k or other type of retirement account. So it could be a 457, 403b, 401a, through a savings plan. Almost all of them have that ability once you separate from employment. So it's usually either a transfer or a rollover or a contribution. And a lot of times it's a combination of those things. And once your account at Advanta is open and it has some cash in it, then you're really going out there and looking for the investments that you want to have your IRA in. And again, today we're lucky enough to have Badri here to talk about what they're doing at Avester, but also to talk about how you might conceptualize building a real estate portfolio. So again, open the account, get some money in it, and then you're looking to invest. And that's a good lead in for our transition here. And I'm gonna go ahead and send the screen over to Badri. And Badri, co-founder and vice president of Avester.com. Thank you so much for joining us today. And I'm going to go ahead and turn the presentation over to you for the bulk of the expert presentation.
Hey, thanks a lot, Clay. Good morning, good afternoon, wherever you guys are. Happy to be here. Clay, can you see my screen? And
Yep.
We are all good, right? Okay.
Sure can.
People have any objections? I prefer not to be in the presentation mode, but the screen is large enough. Please do type in the chat window if you can't see the screen clearly. So what I'm going to talk to you, what Clay said was a perfect lead into what I'm going to talk about. Most of the presentation is an educational presentation. It's about how do you build a diversified real estate portfolio. And so just some legal disclaimers similar to what Clay had said. You should not consider this formal investment advice. Avester itself, a lot of this presentation is applicable to everyone, but Avester itself is open only for accredited investors. I can talk about the definition of an accredited investor later. And real estate investment is not necessarily for everyone. Please consult your advisor before you invest in real estate, yeah? And it's meant to be a long-term, sometimes potentially illiquid investment. It's not something like putting cash in the bank. So let's get started. Building a stock portfolio is not really a problem, right? There are any number of places where you can go and build a stock portfolio. You can decide discretionary stocks, defensive stocks, technology stocks, and you can build a portfolio. Building a bond portfolio is a little harder, but you can still build a collection of bonds. But most people ask, building a real estate portfolio? Now, let me add a caveat. I'm not talking to the Bill Gates of the world. If for those of you who can afford to buy a house in every single state and who can have 20, 30 different houses, and I'm sure you have lots of options. But people with more limited means, how do you go about building a real estate portfolio? That's the question I would like to answer, yeah? So it is pretty hard because what we want to do is help people move from the left to the right, okay? So real estate is one alternative investment. Clay did a good job of talking about all the other alternative investments. There are so many alternative investments out there, but we certainly recommend putting a slice of your portfolio in alternative investments. I'm going to be mostly talking about real estate today. I'm not saying that's the only choice. Let's take that as a given that it's a good idea to build some slice of your investments in your IRA and your non-IRA accounts too into real estate. It's quite hard because you have to find the opportunities. The deal structures can be complex. There can be significant capital requirements. You have to manage the risk. And let me cut to the bottom line. You have not made money until you have actually made money, right? Until you exit the real estate, you may have paper gains, but you have not actually made money. So what I would like to talk to you about today is what are the different types of real estate deals? What do you mean by investing in real estate? Of course, you can invest in a direct house or a rental house, but there are a huge range of opportunities for you to invest in real estate now. What are the top portfolio considerations when you want to build a real estate? What are the key factors? I think Clay hinted at some of those, and I'd like to go into some more depth in that. We'll look at crowdfunding to accelerate portfolio building, and then we'll talk about one technology platform which I'm part of, Avester Inc., which can help you build diversified real estate portfolios. But most of the talk is educational, and we'll spend a few minutes on Avester, which is one of the choices, by no means the only choice. Yeah. So, okay, let's get started, and feel free to jump in with any questions you have. And if it is Clay, if you want to jump in with a question during the presentation, you can, or if you think it can wait till the end. But if it's your choice, I'll let you decide. Yeah. So.
I'll keep an eye on the question console. So everybody do feel free to type in your questions.
Okay, let me. Okay, I'm getting great. I'm just seeing the chat window. People have said, okay, what type of investments they've done. That really helps me. I continue to, I would encourage the rest of you to tell me what type of investments you have done. So, okay. In real estate. You are welcome to share your other investments too, but let's focus this on real estate today. So what are the different ways you can invest in real estate? Well, the most obvious thing is you can purchase individual properties. Some of you have done that. I don't mean your primary house. I mean a rental house or some other form of commercial real estate. You can buy shares in private real estate investment trusts or funds. You can invest in syndication deals. Some of you may already be familiar with syndication deals, but I will give a brief introduction to syndication deals. There could be an entire talk just on syndication deals, so it'll be an overview. Or you could invest in real estate loans. When I say real estate loans, I don't mean the 30-year mortgages, but fix and flip loans or short-term loans. So these are some different ways you can invest in real estate. There are a number of other ways, but let's focus on these ways to start with. Yeah. So. The direct property purchase is pretty obvious. You buy a second home or a small multifamily, 2 to 4 units, or even larger one if you have the cash balance to do that. You put 25% cash down, you take a 75% loan. You either manage the property yourself or you give it to a property manager. And the nice thing about this is you decide when to exit the investment. You're not dependent on anyone else. You have full control over the asset. You make all the decisions. And effectively, the renter is paying off your mortgage, and you get the tax benefits of depreciation and you can write off expenses, right? But what are some of the disadvantages? You really have to put a significant cash down, and you have to assume a debt. Most of us cannot buy an entire rental property paying cash. And then you're tied to your local market. Most people make the mistake of buying all their rentals in the local market. I realize there are some advantages, but then you're putting all your eggs in one basket. One thing my grandmother told me still applies. Don't put all your eggs in one basket. You want to diversify. And then you have to manage renters, you have property issues, and there is really no liquidity in invested capital. It's not that easy to sell a house. It does take some time, right? So the other option is you could do a private REIT or a fund. So there are two types of REITs. You can have publicly listed REITs. A REIT is a real estate investment trust, which trades on the a public REIT trades in the stock exchange. You can buy and sell it like a stock. Here are some examples. For example, Simon Property Group is a REIT which invests in malls. Public Storage is a REIT which invests in self-storage. The biggest advantage is they're very highly liquid, very easy to research, low capital gains. But the biggest disadvantage is there is very little transparency on what underlying investments the REIT is investing in. There is a laundry list of investments, and you don't have any control over, if you don't like some investments, too bad. You get a slice of it whether you like it or not. And here is one of the biggest disadvantages for me. It's still tied to the stock market. The average rate fell like 50–60% during this COVID crash last year. And part of the reason you want to get into real estate is you want to diversify away from the volatility of the stock market. And that it's not quite accomplished with public REITs. Private REITs or funds, they're available through brokers. They're generally exempt from SEC registration. The main advantage is they are somewhat independent of the stock market, and there's a little more transparency on the investments. and generally you invest in an LP structure, the disadvantage is it requires a lot more investor research and there is a fairly limited liquidity. So again, what we are going to do is we are going to talk about this at a 10,000 foot level, and if you have time permitting, we can go back and look at it in more detail. Think of this as an overview talk. At the end of the day, some of you will know about something in this presentation, but hopefully all of you will not know everything in this presentation. That's my hope. So then the other way you could invest in real estate is you could invest in real estate loans. As I indicated, I'm not talking about the 30-year mortgages. These are small multifamily or commercial loans where people are either fixed on flipping a house, or they need some short-term capital to build a house and rent it out or sell it. Notes may have a first lien or a second lien. I highly encourage you to invest only in first lien notes, where if anything goes wrong, you have the first right to the property. You get a fixed interest and all the upside goes to the borrower, but at least you get a fixed interest, and these are shorter terms, right? Shorter term notes. Typically, this can be from 2 to 24 months. You can get anywhere from 6 to 12%. And I encourage you to invest only in notes where you put at least, the borrower has put at least 15 to 20% down. And what are some of the disadvantages? The borrowers may have a limited history or track record. Interest is considered income is considered interest income, so there are no tax benefits. You don't get any of the depreciation benefits. And make sure you invest in loans which are states where you don't have to go to court for foreclosure processes, because that can tie up your money for quite a while. Yeah. So, okay. Here is one of the best ways to invest in real estate, especially commercial real estate. You can invest in what are called syndication or equity deals. And so one question here is, will this webinar be recorded and available for reviewing later? Yes. So I think Clay also answered that question. And so going back to syndication deals, not all of us can afford to buy large apartments, but all of us can afford to buy slices of these apartments. And that's what syndication deals allow you to do. You get a slice of a large commercial real estate deal, which allows you to diversify your portfolio. You can invest in multifamily, student housing, retail, industrial, offices, hotels, warehouse, self-storage space. You can either do new construction or value-add projects. New construction, as is obvious, is the construction you're starting from scratch. It's a little higher risk. You won't get any money in years 1 and 2 typically. Whereas value-add projects it's an existing project where an apartment is renovated and you try to improve it and increase the income and then resell it. And the advantage of that is you start getting income right in the beginning. Yeah. So the deal is generally structured as a limited partnership, and the sponsor is the general partner, and you are a limited partner, and that's called the GPLP. You provide the capital. Typically, you want to invest in deals where the sponsor also has provided at least some of the capital, and then investors and sponsors share in various income ratios. Typically, you get something called a preferred return. What that means is that, like, for example, the first 8% of the rental income goes to you, and then the rest of the money is split between sponsors and investors. And it could be a 80-20 split or a 70-30 split. And you want to invest in deals which are investor friendly and not sponsor friendly. Yeah. So what are some of the pros and cons of syndication deals? The biggest pro is you get to invest in commercial properties which you would not be able to do on your own. Much higher return potential. You may get 15 to 27% annualized returns. You get passive income, and you get all the tax benefits which you get by owning real estate directly without all the hassles of managing it. The main disadvantage is you really need to put 25 to 50 and sometimes even $100,000 for each syndication deal. There is no liquidity. Typically, these deals, you have to tie up your money for 3 to 7 years. You don't have any control over the investment. The GP has full decision authority. And remember, you are investing in an equity position and not a debt position. So what this means is the first lien is always with the lender of the commercial property. And it's only after the lender gets paid back, you get any money. And if you're not careful in selecting what type of syndication deals you invest in, this could result in a full loss of investor capital. Yeah. So, and here are some of the top misconceptions of syndication deals. Passive income is guaranteed. It is not guaranteed. So passive income is, you can look at projections from the syndicators, but the passive income is not guaranteed. It's subject to enough renters being in the property, and if there are not enough renters, you may not get to the passive income you're looking for. Similarly, the targeted returns are annual returns, but that doesn't mean that it'll come regularly every single year. Especially in new construction, most of your returns are backloaded. You get this in years 3, 4, and 5, and not in years 1 and 2. Deals often don't exit on times, and please don't be misled by fancy presentations. I mean, you know, some syndicators are really good at putting marketing collateral together. Do your due diligence, look at the PPM. We'll talk a little bit about what are some of the factors you need to consider later. And syndication deals are not low risk, they are higher risk, but a well-diversified portfolio can reduce the risk and help you build much higher returns than what you would get with less volatility than the stock market. So we talk about all of these blogs in our blog article. If you go to avesterinc.com if you go to our blog page, you can see a lot of the top misconceptions about syndication deals, and we talk about all of this in a lot more detail. And we also have some blog articles about how a syndication deal works, what's the typical anatomy of a syndication deal. Highly encourage you to go take a look at those blog articles if you'd like to learn more. So now let me switch gears here and talk about the top portfolio considerations when you build a real estate portfolio. You want to look at the overall portfolio structure. You want to make sure you're diversified. You want to look at how you select a deal. You want to ensure you have smooth cash flow, and which meets your individual needs. You want to ensure liquidity at various points, and then you want to maximize tax benefits. And I'm going to each one of these points in more detail. Yeah. So, what is the portfolio structure? Let's say you have $1 million. Let's say you have $1 million of assets you can invest in various types of investments. I'm not going to tell you how much you should invest in real estate. That's a conversation you need to have with your investment advisor, or you could contact me offline based on your assets. We can certainly go into that conversation, and I will give my contact information towards the end of the presentation. Let's say you target 15 to 20% of your investment portfolio to real estate. And so if you have $1 million, just for round figures, not all of us do, let's say that you put $200,000 in real estate. Well, you could buy 2 individual properties, maybe 100K in cash and debt, or you could buy 4 private funds at 50K each, or maybe you do 8 syndication deals at 25K each, or maybe you do 40 real estate loans at 5K each. I mean, or you could do a combination of everything. But the main point I want you to take away from this is you should think of real estate investment as a jigsaw puzzle. When you do a jigsaw puzzle, you don't randomly put pieces together. You start with what is your end goal in mind. So I want you to transition from what property do I buy today to how do I build a real estate portfolio over a period of multiple years and actually multiple decades that balances both risk and returns. So you need to transition, approach this as building a jigsaw puzzle, yeah? You want to be diversified across multiple markets. You can say, hey, I don't have that much money. How can I invest in multiple states? There are ways you can do it, and I will talk about it in this presentation. Diversification is critical. I mean, you can say, for example, these were real estate prices in Boston, Portland, Oregon, and Durham. They don't all go up and go down at the same time. Certainly, there is some correlation, but there is enough there's not total correlation. So diversifying into multiple states will help you build a much more diversified portfolio. Yeah. So, and you also want to diversify across multiple asset classes. You want to do both new construction and value add. You want to do multifamily, single family, you want to do build to rent models, retail, mixed use, self-storage. And self-storage is a particularly very nice recession-proof class, because people, when you tend to put something in storage, just because you raise your rent by $5 or $10, and they're not going to just remove it from storage. They're typically, self-storage does well in recession times, So the multifamily asset class is the biggest sub-asset class in real estate. Traditionally a safer asset class. There are a large number of investment opportunities, good cash flow, and this is the primary asset class for real estate sponsors. But some things you should be careful about is often sponsors overestimate the rent they can get after rehabbing a property, and be ready to stay investor for 5 to 7 years in a multifamily asset class. So, and when you look at the deal selection, let's start with the single property purchase. You want to look at the property specifics. You want to make sure you have enough money to service the debt, and you want to make sure that you is it a single renter, multiple renters, and then when you look at real estate loans, you have to look at these factors. You also have to look at the risk of the borrower, what's the track record of the borrower, and then you have to look at the foreclosure flexibility and see if these are in states where you have to go to court to evict the tenant. And then when you look at syndication deals, you have to look at the overall capital stack, debt, how much debt, the LTV ratio for the debt, and the structure of the deal, and the track record of the sponsor. And please research every single deal thoroughly to minimize any risk. And we'll go into some of this in a little more detail later. And then you have to look at the cash flow. Make sure if you purchase a rental property, you get monthly income, hopefully after you pay off your loans, and this goes on for a while, and then you sell the property and you get some appreciation. In a debt deal, it can be structured so that you either get monthly interest or you can get accrued interest at the end of the deal. Be aware of how the debt deal is structured. In an equity deal, unless it's a value add deal, typically there is no distributions or limited distributions in early years, and you get the distributions in later years, and then you get a lot of the income when the property is sold. That's in year 4 or 5, when typically at the end of the syndication deal investment. Yeah. So you have to build a portfolio and take into account the cash flow considerations before you build your portfolio. And then you obviously want to build liquidity. The advantage of a well-built portfolio is you can have liquidity items where life often throws you a curve, right? I mean, you don't want to. You may think you may not need the money, but it's much better to build a portfolio where you have some loans, where you have some syndication deals, where you get liquidity at periodic intervals. And then if you don't need the money, you can always reinvest in it. So portfolio liquidity is a key factor you should consider when you build a portfolio. So, and then tax implications. So at the end of the day, the dollar you keep is the dollar you pay after paying Uncle Sam. Be aware that real estate loans, typically you get 1099 INTs, and there's regular interest, which is taxed at regular income tax rates. For syndication deals, you get a K1, and that gives you profit and loss and the depreciation benefits. And for real estate investment trusts or funds, you may get a 1099 div or a K1, and typically TurboTax or something works fairly well. One of the disadvantages of syndication deals is that if you invest in 10 deals, you get 10 different K1s. And that's one of the advantages of the Avester platform, which I'll talk about. Even though you invest in 10 or 20 deals, we give you a single K1. We have built the technology and the legal infrastructure behind that. So be aware of the tax trade-offs. And if you do want long-term capital gains and you want income to offset your other income, you want to go with syndication deals. But if you want regular income, you really want to go into hard money loans. Yeah. So crowdfunding. What is crowdfunding? Well, at the risk of being accused of having the uncanny grasp of the obvious, crowdfunding is crowd and funding. It's real estate sponsors are getting funding from a crowd. So these are online marketplaces that give investors an opportunity to invest in real estate deals. And again, you can participate in larger projects. The advantage is that these are passive investors. You can be a passive investor and leave the complex project management to experts. and you can get portfolio diversification because you can invest small amounts. But here is the key point. Crowdfunding platforms, you should be thinking of them as sellers agents and not buyers agents. So because their interests are aligned with the sponsors for who they're raising money for, and they get paid for raising money quickly and efficiently, you really need to assess the quality of the deals. Please don't fall for pretty pictures and marketing materials. Understand your rights, and please read the PPMs and the limited partnership agreements. Don't go just based on the advertised returns. That assumes that everything goes right. Look at the financial projections, make sure that it's not too rosy, and be aware that some of these deals will take longer to exit. So there are different types of crowdfunding platforms. There are crowdfunding platforms where you can go buy complete properties, and some of them, sometimes you can buy a property in another state where it's already rented, or you can diversify into multiple commercial properties with a single investment where with a private REIT or a fund. We talked about that. Or there are crowdfunding platforms which specialize in individual commercial equity deals. Or you can also go into crowdfunding platforms where you can buy slices of real estate loans. So contact me offline and I can tell you a little more about examples of each of these crowdfunding platforms. So I will pause here for a second, and I'm going to, let's go ahead and take questions at the very end of the presentation. Unless, Clay, do you have any quick questions before I switch to a brief overview of Avester? Since I don't have access to the questions, Clay, do you want to speak up and see if you have any questions which you want me to address?
I think that they'll be better addressed at the end. Let's go ahead and go forward.
Okay, sounds good. Thanks, Clay. So what I've talked to you so far is how do you build a real estate portfolio using various real estate sources? And one platform which I'm a co-founder of and vice president of is Avester. Avester, in some sense, is the world's first customizable real estate portfolio platform. So it's a fund which is customizable as opposed to one size fits all. Today, a real estate REIT or a fund is more like a pie. I don't want to make you hungry. I think it's lunchtime in the East Coast. In a pie, you don't get to choose the ingredients, and you just get a thin, medium, or thick slice based on the amount of money you put in. Whereas we are more like a buffet. You can go in and say, I want to invest in this deal. I don't want to invest in the other deal. You can put $10,000 in this deal, $5,000 in another deal. And you can build your own buffet plate, and you can customize a portfolio across multiple markets, different property types, and different time frames to get a combination of passive income and capital appreciation. Okay. So what are some of the key features? We don't just recommend a deal. The Avester partners actually evaluate hundreds of deals, and we pre-invest in the best deals. We have a mathematical model which evaluates, takes into account dozens of variables. And then you as an investor come along, just like you go to an investment advisor and say, I want 80% stocks, 20% bonds. You can come along and customize your portfolio. We do both syndication deals and hard money loans. You're diversified across multiple states, different time horizons and asset classes. And think of us like the fidelity of real estate, where you can track how each slice is doing. I mean, we don't just give you overall fund performance. You can actually come in and see, I'll give you a quick demo, and you can come in and see how each slice is doing. And then you can withdraw the money as the deal exits, or you can reinvest. And here is the best part. Even if you invest in 25 plus deals, all of this is packaged in one single LP, and you get to choose each one of these deals. And then the best part is you get a single K1 instead of having to deal with 10, 15, 20 different K1s, which can be a hassle during tax time. Yeah. So again, our model is as follows. We research the deals, we pre-invest in the most attractive deals. Again, I want to stress, we pre-invest in the deals. We believe in it, that we put our own money in it. And these deals are cut into slices. Investors come along and set their overall portfolio direction. We match the slices and build custom portfolios for investors, and you get a pro rata share of the earnings, and you can withdraw the money as the deal exits, or you can reinvest. So Here is a hypothetical example. I'm not going to spend too much time on this because I'm going to show you an actual example. We have the investor's permission to show you that actual portfolio. The main point is you can invest as little as $500 in loans and as little as $2,500 or $5,000 in syndication deals. You're invested in multiple states. Remember all the things which I mentioned about diversification across asset classes, diversification across multiple sub-asset classes and multiple geographical areas. You can do all of that using this single platform. You can specify your time horizon. You can come in and say, I don't know, I have a kid going to college in 2 years. I want half of my money back in 2 years. And we try to structure your portfolio accordingly. You can invest in single and multifamily, student housing, apartment complexes, office and retail, and so on. Yeah. So as I indicated, we do both syndication deals. We already talked about what a syndication deal was, and we generally pick the lower risk categories, multifamily, luxury. Typically, the return on these deals are between 13 to 25%. And we also do hard money loans, typically between 6 to 15 months. So syndication deals are 3 to 5 years. I'm trying to give you the trade-offs between the two. You get 13 to 25% projected returns. Here it's more like 7 to 12%. And these are subject to long-term capital gains, whereas these are subject to regular income taxes. We never invest in any loans. I follow the same advice I gave you. We never invest in any loans where we don't have the first lien on the property. We don't invest in second lien loans. Yeah. So you can invest as little as $500 in each real estate loan and as little as $2,500 in each syndication deal. Wouldn't you rather put 2,500 in 20 different syndication deals rather than put $50,000 in one deal? That's our value proposition, basically. Here are some of the deals we have done in the past, just to give you a flavor. Morehouse School of Medicine, Atlanta, Georgia, apartment complex in Michigan, self-storage in North Carolina, a retail. And before you get saying, oh my God, retail, that's not good. It's rented to Lowe's, and trust me, Lowe's is doing quite well during the pandemic and afterwards too. Another multifamily in Phoenix. We really like this last deal. It's a built to rent, a single family community near Dallas. Yeah, just to give you a flavor, I'm not going to go into too much details. You can contact me more offline. Yeah. So now I'm going to take a quick second and we'll give you a quick demo of the platform, and then we'll take questions. So let me log in here. Get your questions ready. I'm happy to get into any questions here. So I'm not going to spend too much time on this. Please contact me offline if you would like to get a more detailed demo. But the basic idea is, again, think of this like the fidelity of real estate. You log in, you see your account balance, the number of deals you're invested in. This person is invested in 48 deals for an account which is just $77,000. This is the return on the deals which have exited. These are actually not hypothetical returns, deals which have exited. And the reason it's a little low is because debt deals exit faster than syndication deals. This is a breakdown between debt and equity and how the portfolio is structured. I'm not sure what to call this. We'll call it a vanity map. It shows you how your deals are distributed across the country. You can click on anything and get more information about each individual deal. And here's a performance summary. And then this is a liquidity graph, which we build based on when you come in. Please be aware that in real estate, it's not precise. It's not like a CD, which is going to mature on a particular date. And then you also have the portfolio details page, which gives you all the information which you need for each slice. Like I told you, think of this like when you log into your stock brokerage account, you want to see how each slice is done. And these are all debt deals where he's invested $500 to $1,000. Let me look at something more interesting. He's put $2,500 in a variety of equity deals. I'll just pick something. Federal self-storage. He's made $275 in the 2,500. It's completely transparent, and you can click on this and get a lot more information about each deal, including the legal documents, any updates, and so on. So I'm going to pause here for a second, and let me just mention one last thing. We don't take any back-end fees from the sponsors. We are completely aligned with the passive investors. So the only fee we charge is a 1% fee for accounts above $100,000 and 1.25% fee for accounts below $100,000. And then there are some partnership expenses. Last year it was about 0.35. We expect it to be closer to 0.3% in addition to that. So, and one last thing before I kind of wind up, we do a very sophisticated analysis of all the deals. We evaluate hundreds of deals. We look at, take a detailed look at the capital stack. We look at the financial risk. We'll see if the deal is investor friendly or sponsor friendly. Take a look at the track record of the sponsor, and we pre-invest only in a small subset of deals, and then put them out in our storefront, and you can pick and choose what you want to invest in. And frankly, we are a glass half empty type of people. We look at what can go right in, what can go wrong in a deal as opposed to what can go right. And that's kind of our value proposition. So here is my contact information. And I am going to, if some people have asked, where can I download this presentation? I'm going to provide the link for that. You can go to our website and download the web presentation. I'm going to put that in the chat window. I'm going to put my mobile phone and my entire contact information in the chat window as well. And I'm happy to take any questions now. So.
Great. Well, thank you, Badri. That was really an interesting take on the landscape there. And so I think what I'm hearing, and I'll just state back to you, you're happy to be an ongoing kind of resource for folks. They're welcome to contact you about the specifics of the presentation or even some of the general strategy things. Is that true?
Absolutely, absolutely. Please reach out. I mean, if you call me, if I'm busy, I'll call you back. I'm just giving you my mobile and my email address. And you don't have to reach out only if you're interested in Avester. If you just want to talk about real estate investments and you want to talk about, okay, how do I go about building a diversified portfolio? And by no means I'm saying that Avester is the only platform which is out there, but I'm happy to talk to you about it. Yes, Clay, that's correct.
Terrific, thank you. Okay, so I'm going to get both our contact information up so that folks can see that.
Okay, great.
And we'll answer some questions. So the first one is kind of a general one about Avester. So can you provide a little bit of background about Avester? When was it founded? How many investment options do you generally have on the platform at a given time?
Okay. Kind of thing. So Avester was founded a couple of years back, and the reason we founded this is we were frustrated with real estate investments because some of these syndication deals, they go really fast, and I don't know about you, if you have a full-time job, you don't have time to search around hundreds of deals and try to evaluate them and be there in the next 30 minutes to buy them. And so we opened it to friends and family initially because the single K1 is pretty complex. We have spent hundreds of thousands of dollars in the technology and the legal infrastructure behind it. And we opened it to the general public last year, and we have had a tremendous amount of interest. And to answer your question about how many deals, it varies. Sometimes the deals get sold out pretty fast in our platform too. But typically we try to have at least 3 to 5 equity deals and 1 or 2 equity deals coming every month. And then we try to have about 15 to 25 debt deals. So the second you come in, the minimum investment in Avester is $50,000, but you can spread that among more than 20, 25 investments, and you can get a combination of both debt and equity. Think of it like the stock bond portfolio, 70% stocks, 30% bonds. Similarly, here you can maybe do a 70 or 80% syndication deals and 20% equity. So I don't know if I answered that question.
Well, I'll follow that up too. So the live example portfolio that you showed us, that was a large number of specific slices of the pie. Is that common to have somebody who has? I mean, it looked like there was 40 or 50 of them. Yes.
That is a little higher than usual, but 25, 30 investments are very common, and people are very happy about that. So.
Okay. So one attendee is asking, how can I bring syndications I'm working with to Avester for funding? Is that a possibility?
So there are 2 things I want to mention. So we use the same model. Reach out to me. I mean, send us your PPMs and send us your financials. We are happy to evaluate it. And then if it passes our criteria, we typically invest $50,000 to $100,000, sometimes more. And as far as you're concerned, we are one investor, right? I mean, Avester is one investor. You don't have to worry about all the investors in the back end. That's one part to your answer. And the second part is, I'm very pleased to announce, as of just a couple of months back, we found that many sponsors and syndicators came and talked to us. Hey, we love the platform. We want to create our own custom mini fund. So we have also developed a SaaS platform which other syndicators and real estate entrepreneurs can use to create their own custom mini fund. And again, reach out to me for that too. You can create your own fund. It'll be co-branded, and you can manage your investors that way, and it'll allow your investors to build a long-term relationship with you, as opposed to raising money for one deal at a time. Yeah. So.
Okay. So there's a question about, can I open a self-directed IRA with Advanta and invest with Avester deals? How does it work? 2 accounts. So why don't I go ahead and take the IRA part, and then Badri, you can talk about the rest. So because you and I were talking about this before the presentation. So the idea for the IRA investor would be, you have an account with Advanta, has some money in it, obviously needs to be up to the threshold of the minimum, but any amount above that. And then what happens is the investment is actually a single investment, at least from our perspective as the custodian, in the Avester platform. And so what would happen is you would instruct us, hey, send $50,000 to Avester, and then that would land on the platform. And at that point, you would deploy the money and divide it up in whatever way you chose. But from us as a custodian, what we would see is you chosen to invest at that Avester platform. It would be considered a single asset for us. And so if you're familiar with our fee schedule, the whole thing would look like $50 to open your account, $95 transaction fee to kind of put that asset in your IRA, so to speak. Usually we'll wire the money out, so that's a $30 outgoing wire. So $125, so $50 to open, $125 to get the money over to Avester. And then the only ongoing fee for our perspective would be the flat. And so at anything over $30,000, it's going to be $295 per asset per year. But of course, all we're going to see is one asset, even if you had 40 of the Avester slices in your account at Avester. So you're able to have as many of those as you want. We will only see that as one asset, this chunk of money at Avester. And so that's the general look at how the self-directed IRA part would work. Badri, would you like to weigh in on what happens once the money gets there?
Yeah, exactly. I think, Clay, you did a great description. So when you log into your Advanta IRA account, maybe you have 50,000 in Avester, maybe you have 50,000 in crypto, and Advanta does a nice job in providing you a wide range of choices. And we work with Advanta in providing periodic updates so that the total value of the account is updated. But then you will get to log into Avester, and then you'll get exactly the same experience I just showed you. You'll be able to pick and choose your investments. I mean, you can talk to us, we'll give you advice, or we can invest for you based on a predetermined allocation. And you can log in anytime, and you'll get periodic updates. And when you go back to Advanta, you will get more of a consolidated view. But when you log into our platform, you will get that single slice view and how each slice is done, and you'll get to pick and choose your investments and build a custom portfolio. So.
Right, so it is a little bit, you would have 2 different views, slightly different levels of detail. So obviously you have an online portal at Advanta, you get to see your entire IRA. With your Avester platform, you'd be looking at specifically what's happening in that section of your IRA. So you have access to
Exactly.
Yeah, access to
you don't have to look every single day. This is not like a stock market account. I mean, it doesn't change every single day, but maybe you can log in once a month or 2 or whatever to see how each slice is doing. So.
Got it. That's a good specification. So this is a great question. So as an investor, what's the risk we have in doing business with Avester? So you talked about being kind of having an eye toward the glass half empty mindset. What risks should somebody be considering when they're thinking about investing at Avester?
Well, any risk involved in real estate is also involved in Avester, right? We try to reduce the risk. Our value proposition is very simple. Instead of putting $50,000 in one syndication deal, wouldn't you rather put it in 20 different deals, which are well screened? Now, we are not going to say that we are the world's greatest screeners, but we do have a pretty rigorous model we have tested in literally hundreds of syndication deals. So, but syndication deals inherently have a higher level of risk than putting your money in CD. So you're taking that level of risk, but what we try to do is reduce that risk by diversifying it into multiple assets and also giving you an option to overlay a debt instrument where you can do hard money slices. And the other point I want to mention is if you, Avester, while it's a startup, we have clearly decoupled the fund itself. So your assets, you would be a member of the LP and those assets would be in the LP. Regardless of what happens to Avester, those assets are safe. And when the assets exit, your money will come back to you. So I would say the risk is the level of risk which you have when you invest in real estate, right? It's not like putting your money in a CD, but then you're getting significantly higher amounts of return, both in the equity and the debt deals. So.
And I think that that's part and parcel to having a self-directed IRA anyway, is that, you know, again, the investments that you choose, it's your due diligence, and there is risk. There's no two ways about it. So we want to be upfront about that so everybody understands
Exactly
that is something that you're dealing with. Yeah, so there's a question here about if someone has a checkbook control IRA. And so, Badri, we have not talked about this. So somebody, if they have an LLC that is a subset of their IRA, can that LLC just set up an account at Avester?
Yes, each member of the, so one thing I did want to mention briefly, but I want to reiterate, while we would like to extend this to a broader audience, as of now, this is a 506c fund, which means it's open only for accredited investors. So as long as each member of the LLC is an accredited investor, you're okay. And I'm going to just take 20 seconds and describe what an accredited investor is. Your audience may already know. You need to have, if you're a single, investing as a single person, $200,000 of income in the last 2 years, or you need to have $1 million net worth. It can include all your retirement accounts, excluding your primary residence. But one very important point, SEC now, again, reach out to me offline if you want to know more details about this. There are guidelines which have come out from SEC a couple of months back, which allows you to take an exam and become an accredited investor. That's great news for people who may not have the $1 million net worth. It gives you a much broader range of investments, apart from Avester. I'm not saying Avester is the only investment available for accredited investors. Reach out to me, and that's a way of becoming an accredited investor. So, but anyway, to answer your question shortly, each member of the LLC has to be an accredited investor, and the LLC can invest in Avester. Yes. Mm-hmm.
Okay. And so typically a checkbook control is going to be a single member, so it would really just be that person. And I'll just extend the accreditation piece, because an IRA is considered to be accredited if the IRA holder is accredited. I run into this myself. So that's the way that at the moment that the IRS is treating this. So if it's the individual who is the IRA holder, and if it's a single member LLC, then that would follow that LLC. So it would need to be that the IRA holder is accredited personally, and that would then translate down to the LLC. Okay. And to reiterate, what's the minimum to invest with Avester? Did I hear 30,000? Is that what the minimum is?
50,000. So 50,000 is the minimum, but you can invest that in any combination of debt and equity, and you can put as little as $2,500 in each equity deal. So.
Right. So 50,000 is the overall minimum, and then once it's in there, your smallest slices are much smaller increments.
Correct. 500 for loan investments and 2,500 for equity investments. So.
Okay, great. Does Avester have a fiduciary responsibility? The question is written, what is the fiduciary responsibility of the Avester entity?
Since we are an exempt reporting advisor, we do not have official fiduciary responsibilities. But having said that, all these deals are something we are pre-invested in, and we don't take any money in the back end from sponsors. I want to reiterate that. So our interests are completely aligned with the passive investors, but we are an exempt reporting advisor. So we don't have the same level of fiduciary responsibility as a registered investment advisor. So at the end of the day, you can choose what you want to invest in. We give you pre-screened deals and you have the choice. For example, you can say, hey, I'm already in California. I don't want any more exposure to California, or I want more exposure to the Sunbelt states. I want more exposure to Texas or Austin. It's such a hot market. You can choose that. So we do give some suggestions. We tell you why we have invested in a particular deal, but ultimately it's your decision on what to invest. So.
Okay. And there's a question: how does somebody participate as an LLP with Avester? Is that the same thing that we were talking about with the LLC?
Correct. Each member of the LLP will have to be a accredited investor. So.
Okay. What determines the time to exit on these sliced up deals? What if an exit is needed prior to that? So are there exit strategies that are continuous, or how locked in is that?
So as of now, while we may consider a resale marketplace down the road, that doesn't exist today. So once you invest in a deal, you have to be prepared to wait until the deal exits. But the good thing is we don't invest in, there are syndication deals which are 7 years, 10 years. We don't do that. Typically our deals are between 3 to 5 years. And because you have so many slices, I mean, hopefully you're not investing in only equity deals which are all 5 years out. You can invest in some debt deals which are 9 months, 12 months, and then as the money comes in, you can decide. But the short answer is once you invest in a deal for that particular slice, you have to wait until the deal exits.
So it's important to choose the slices according to what your liquidity needs are going to be.
Exactly. And add some buffer. I mean, real estate is not like a CD. I mean, if you have hardcore liquidity needs, which you need money in 6 months, don't go into real estate, please. Put your money in a CD. But if there is some flexibility in your liquidity needs, that's when you should go into real estate. So.
Okay. And I think that we've gone a little bit over the hour. I appreciate you spending extra time with us. I think I'll wrap it up with this last question, and then if other questions come in after the fact, I'm happy to field those and forward them to Badri, and I'm sure that he's happy to answer them as well. So if you're still typing, please do continue to do that. But the last one is just, so how many investment choices are there in the system today? I mean, what does that look like? How many choices does somebody have at the moment?
Like I said, it varies from day to day, but I'll answer the question for today. Today, we have 5 different equity deals and about, I have to check, somewhere between 20 to 25 debt deals. So typically, the number of debt deals will be much higher than the equity deals because the equity deals tend to sell out pretty fast. One of our last equity deals sold out overnight. I mean, our share of it, right? If we buy $100,000 worth, we slice it into $2,500 chunks and allocate it to investors. So the short answer is about 5 equity deals and about, let's say, 28 debt deals today, as of today.
And how much variability is there? So in a week, do several of the equity deals close and new ones come online, or do you have a sense of that?
Typically, we get a couple of new equity deals every month, sometimes more, sometimes less. Because we don't want to be constrained on, oh boy, we don't have an equity deal this month, so we better invest in some deal even if it's not good. I mean, it has to pass our criteria. Sometimes good deals come in bunches, like life, right? Sometimes good things happen in bunches, right? So,
sure.
But you really, if you are willing to do a diversified portfolio and you want a combination of debt and equity, your money, unless you're investing $500,000, we have some accounts which are more than $250,000 in our portfolio. But if you're doing a typical $50,000 investment, you can expect your money to be deployed typically within a month or even sooner, So unless you're very picky about your equity deals, and you have very strong requirements on different types of equity deals, So.
And that brings me to one other question, just as a logistics thing. So once the cash is over there, is there a minimum? Is there an amount of time that the money has to be deployed, or can it stay in cash until each investor chooses each of their pieces?
You can stay in cash until you're comfortable with it. At the end of the day, this is your account. You get to choose. You have complete control over it. You can definitely stay in cash. Our recommendation is, instead of staying in cash, take at least the 6-month loans. So you're getting 8, 7, 10, 8, 10%. And then as the money comes in, as you get more comfortable, you can get into equity. But the short answer to your question is you can stay in cash as much as you want. So you don't have to be forced to, oh, I have to buy this within a certain amount of time. So feel very comfortable with the deal before you invest.
Okay, great. Well, Badri, thanks so much. I want to stress, I think I may have said Avester and given the wrong web address. So it's avesterinc.com.
Oh, yeah, thank you. Yes, it is avesterinc.com. You can see it on the screen. And I also typed my full contact information. If you want to cut and paste it from the chat window, please do so. And thank you again. And feel free to reach out. It doesn't matter if you're not interested in Avester. If you just want to talk about building a diversified portfolio or anything which I said in the presentation resonates with you, you want to reach out and chat, please do so.
Great. Well, thank you. And thank everybody for thank you out there, the audience, for spending some time with us today. Hopefully this was helpful, and it will help you to kind of craft the kind of real estate portfolio that will work best for you. Please do feel free to contact Badri and I as we can be of service about the 2 different kind of pieces of what we talked about today. And again, have a great day, have a safe day, and happy investing. If you did not get a question answered on the presentation itself, we will email you an answer. And have a great day, everybody.
Hey, thanks everyone, and thanks a lot for the opportunity, Clay. That was great. I appreciate it.
You're welcome. Bye, everybody.